Okay, we'll get started. Good morning, everybody. This is Chuck Williams with Finspire. And first, I'd like to thank you all for attending our webinar today, which is on practical and tactical actions for corporate retirement plans amid economic uncertainty. This is the first in a series of webinars we will be doing to educate and inform our institutional clients and their employees, as well as our wealth management clients, on the impact, opportunities, legislative changes, strategies, et cetera, in response to this unique environment that we're all suddenly thrust into. So those of you who aren't aware, Finspire is an institutional retirement consulting firm whose primary focus is helping our clients with the three key areas of retirement plan management, being investments, plan governance, and participant outcomes. I'm the co-founder of Finspire along with my partners James Jaramillo and Chris Karam. I serve as a CEO and senior plan advisor for a firm. In addition, I'm an adjunct professor at Northwestern University's School of Continuing Studies, where I've been teaching retirement planning and employee benefits course for the past 15 years. Joining me today is John Carl, who is a founder and president of the Retirement Learning Center, which is an independent retirement plan resource group utilized by the largest retirement plan consulting firms in the country. So you may not be familiar with the Retirement Learning Center, but those of us in the industry are. They are often the people behind the scenes that we go to as advisors to really get in-depth technical answers to many of the questions we have. So they've been a terrific resource for not just Finspire, but really the whole industry at large. So we're very happy to have John on our call today. And joining him is Heidi Lemure, who is a senior ERISA consultant at Retirement Learning Center. In addition, the founder and president of the Retirement Learning Center, John is also a guest lecturer at the TRAU, which is the Retirement Advisor University at UCLA's Anderson School of Management. John also serves on the Government Affairs Committee for the National Association of Plan Advisors. So a little housekeeping before we get started. We anticipate this presentation to last approximately 40 minutes. All attendees are on mute. If you have questions, please feel free to ask them in the Q&A box, and we'll attempt to answer as many of those as possible throughout the duration of the presentation. If we don't get to them, happy to follow up with you afterwards to answer any additional questions. We'll also have a couple polling questions throughout the presentation. Answers to any polling questions are anonymous. I encourage you to answer those, and we'll give you the feedback immediately as we go through the presentation. So our agenda for today, one is just to go through how we got here. It's an unprecedented economic environment, as we all know. So we'll talk about where we came from, where we're at now, talk about the government's response to a situation we're in, review 401k plan decisions, and then finish with plan sponsor best practices. So here's our disclosure. The subject matter is education only. We're not providing legal, accounting, or investment advice, and to consult with your counsel and advisors. So prior to getting started, I'm going to ask James Jaramillo to put up a poll question that we have. So if you would answer this quickly, prior to the recent economic downturn, were you planning on making plan design changes in 2020? So it's interesting how much has changed recently. And it's curious, were they planning to make a change before this? Curious, or what's happened is that facilitated a change. So looking at the responses now, and I'll in the polling, so interesting, 91%, up down about 85% of the companies or respondents said they were not planning to do that, to make any changes. And just 15% were. So it is interesting, a lot, most companies have made several changes. They weren't planning to do it, but that might be changing now. So get a little background on this economic environment we're in, and we'll talk about pre-COVID-19 and then the current environment. And we'll look at pre-COVID as really, I put the date as February 24th. And that was a day where certainly the COVID, or we'll call the coronavirus at that time, we were aware of that in China, but that is where it really took effect. And you might recall it was a Monday. It was right after Bernie Sanders won the primary in Nevada, and the big news came out of South Korea and Italy that it had now spread outside of China. And that is where really a big impact. And in the 6 weeks, it's amazing how much all of our lives have changed since then. So looking back, and this seems like a long time ago, but again, really just 6 weeks ago. Before this happened, low unemployment, low interest rates, low inflation, steady economic growth, 2 to 2.25%, fairly consistent. Relative cooperation between the oil suppliers. So that's sort of a significant part of the story that's not been covered as much. Very steady corporate profits and strong performance and minimal volatility across the stock and bond markets. So coming off of 2018, we had record returns in the equity markets. Bonds had stock-like returns for the year. And it was just an exceptional year. Everything seemed to be going well. So since then, you have this social distancing recession. So this is very different than 2007, 2008, which was a financial crisis. And the response to healthcare crisis is what's causing a financial crisis. We have an unprecedented US government response we'll touch on. And in the middle of this, or toward the end of the last 3 weeks, this oil price heats up between Saudi Arabia and Russia, which has a significant impact. We have extraordinary market volatility in stock, bond, and energy markets, and a huge spike in unemployment numbers and unemployment claims. So how the government responded. First started out with phase one, this $8 billion stimulus package for health agencies, testing, small business loan subsidies. Phase two comes in shortly thereafter, giving employer tax credits for paid sick leave, increased unemployment benefits, and food assistance. And then the big one that just came out, and again, just a week old, is phase three, household checks being sent out, travel industry bailouts, loans and grants for small businesses, additional legislative changes. And then there's talk, is there a phase four? And we don't know that yet, but certainly discussion about it. The Fed steps in, monetary action, Federal Reserve's cutting interest rates dramatically, infusing liquidity into the bond markets as well. And then legislative changes, these temporary legislative changes, greater access to 401k plan assets through the CARES Act and small business loan provision, this payment protection program. So I mentioned this is something, a payment protection program is definitely for small business under 500 employees. A lot of discussion on that. You're going to see that very soon in a future webinar that we'll be having as well, because again, a lot of people have questions about that. So a quick summary on some of the impact to retirement plans in this CARES Act, because there's a lot of questions and confusions, and frankly, some unanswered questions. So really two main things: qualified plan distributions for COVID-19 related expenses, qualified plan loans for COVID-19 related expenses. First, look to the third column there. What are COVID-19 related expenses? And this is very important. So this is, in order for an employee to be able to act or take advantage of these new loan and distribution features, they have to have an individual spouse or dependent diagnosed with COVID-19 or SARS and result in adverse financial consequences as a result of one of these situations. And the key, that third bullet point, is it's self-certifying. So a lot of plan sponsors are asking me, do I have to determine if somebody had this adverse financial consequence? And you don't. This is something that if you opt to put this into your plan, the employee is going to be self-certifying whether or not they are impacted by this. So these are two features. Again, qualified plan distributions. So plans can allow, the key thing is you may allow up to 100,000 in-service distributions aggregate across all plans. So with this, the company doesn't have to. It is up to them whether or not to put this into the plan. It's not subject to a 10% early withdrawal penalty if under 59.5. Don't have the 20% withholding. Really interesting feature on this is while it is taxable income, the employee can decide whether they want to have it all taxable in this year or have it allocated across this year and the next 2 taxable years. Also interesting is they can roll the money back in within 3 years of date of distribution. And this is available through the end of this year. So that is one option you can put into your plan. You can also add in this additional loan feature. Allow loans up to the lesser of 100,000 or 100% of vested balance. So the current loan max is 50% of vested balance up to 50,000. So basically doubles that. And then upon request, plan sponsors must suspend loan repayments on outstanding loans that are in good order for a period up to 12 months. So if somebody is making a loan to suspend those payments up to 12 months. However, the interest accrues and would be added to the balance when it eventually is reamortized. So when I am talking to participants, and this is all very new, is thinking of doing this, keep in mind your loan payment down the road will be higher than it is today when it starts up again. Also available through December 31st, 2020. So these are a lot of the questions we're having on these new loan and distribution features. Very important that you talk to your advisor and also your record keeper, because different companies are doing this, different record keeping firms are doing it differently. We work with some record keepers where they're just automatically defaulting, assuming everybody wants to do this. Others are making, it has to be an elective decision. The other thing is with this, a planned amendment, you don't actually have to have the amendment in place until 2022. So you can have this automatically start using this right away. You don't have to worry, normally you'd have to wait till your plan gets amended and so on. You don't have to do that. Now there still are some outstanding questions. One of the big ones is Roth. What happens with Roth if somebody takes out? Is that taxable? And if it is, what portion of it is it taxable? So those are things that are still coming out. So all of this is continuing to evolve. But these are kind of the main things that we see companies doing with the CARES Act. There's other things as well, impacts of defined benefit plans, non-qualified deferred comp plans. There hasn't been any new guidance on that. We have a lot of discussion with non-qualified deferred comp plans, clients of ours, on how this impacts them. And then other CARES Act components, required minimum distributions are waived for 2020. So anybody over, now with the Secure Act passing last year, now it's over age 72. Tax filing deadline and extended to July 15th. However, Illinois didn't change their deadline. A really important thing to note. So if you're in Illinois and you're an individual filer, you still have to get the Illinois tax return in by April 15th. But the federal is extended to July 15th. So one thing, just note whatever state you're in to check that. Don't assume that the state extended the deadline just because the federal government did. Then there's taxpayer rebate checks up to $1,200 per individual plus $500 per qualifying child. This is phases out based on income levels. This paycheck protection program, again, this is a lot of banks are ramping up. The first loans that are available this Friday. And this, again, we have plenty of materials. If you want to reach out to us, we're happy to get that to you. But we'll also this will be a subject of a soon to be future webinar. Expanded unemployment benefits and suspension of student loan payments, collections and wage garnishments through September 30th. So as you can see, this is a lot of changes coming in to the plans with these CARES components and just the economic environment. So the challenges that are facing companies now are, how do we preserve the health and well-being of our employees while decreasing overhead? So every company I talk to, and I give them so much credit, the business owners out there and on the call here, it's a very difficult time. And the response I get time and time again is, we want to take care of our employees and health is at the top of the list. And I think just across the country, it's amazing how business owners have stepped up to do that. And with the cost to them, significant up to them personally. But that's what they're looking to do. How do we do this? How do we take advantage of unique opportunities to build long-term profitability? It's also been interesting talking to a lot of clients and business owners on, hey, this is what we're looking at. This is a chance for us to reinvent ourselves. We're going to change something going forward. How do we do this? Maintain financial flexibility. And again, this is so different than 2007, 2008, where there's just a gray area. We don't know when this is going to end. So companies are just maintaining that flexibility and trying to weather the storm in anticipation that we're going to return to normalcy. So what I do hear consistently from economists, market analysts, is eventually this is going to return to normalcy. So if it is, we all believe that's eventually going to do that. We want to make sure we're prepared for it. And we're not making significant short-term damage to our company that prevents us from returning back to normalcy and the profitability that we enjoyed before the situation began. So with that, we're going to go to discuss what plan sponsors are asking. And I mentioned I have John Carl on the phone, and we're really excited to have John in the group. His team fielded, he said, over 1,000 calls from advisors just in the last month on plan design. So we've got great insight from his group, as well as Heidi, a senior ERISA consultant, on what questions that they're seeing. So I'd ask, we're going to go through these questions with you. At the end of it, we're going to have another poll question on these, saying which of these apply to you. So just start thinking about that as we go through, and we'll have a quick poll at the end here. So John, for the first question, can a plan be amended to remove employer contributions? I would say personally, this is one of the #1 that we see, and I'd like to get your input on this and your take on this question that's being asked.
You betcha, Chuck. And it is the #1 question that we've received as in our national resource desk. Can a standard 401k plan, or even including a 403b, be amended to remove the employer contributions? Well, the answer is yes, but the first thing that you have to do is have an organization like yours on the ground, like a Finspire, read through the plan document. It's really important to note whether the contributions are either discretionary or they're mandatory, meaning there's some type of a formula in the plan document. So the first step is the answer is yes, but you've got to read the plan document first. So let me break it into the two categories. If it's a standard discretionary, non-elective, or matching contributions, you can indeed reduce or eliminate those at any time by the terms of the plan. So the employer has the option to either make them or not per the plan document, so they can make that amendment at any time per the plan document. Now, although it's not really required, communicating that change to participants certainly would be at a minimum beneficial, and the best practice is generally to make a notification, 30-day notification of the changes if your participants have already become accustomed to receiving some form of contributions regularly in the past. But typically in that instance here, as I said, there's no plan amendment that's required. It's already in your plan document. We just have to review that, have the Finspire folks review that. I will also caveat that, Chuck, that non-discrimination testing should also be looked at, because that's going to impact the HCEs versus the non-HCEs. So, that's something for the business owners to take into account, that it is going to impact non-discrimination testing. Now, the second group is if it's a mandatory employer contributions, meaning that there is some formula that exists in the plan document. And again, that plan document review is essential. It'll tell you whether you have that or not. But those also may be eliminated by mid-year on a prospective basis by amending the plan document. So you can eliminate and change, but you can do it only on a prospective basis, and there has to be an amendment to the plan document made. But it can be done, and it can be done now. So the employer must make the contributions for the portion of the year prior to the amendment for those who've already satisfied their eligibility requirements to receive it. For example, if a plan has what we call a last day requirement to receive a contribution, a plan amendment to eliminate that contribution may occur anytime before that last day. If the plan does not have a quote-unquote last day requirement in the plan, but it has an hour of services requirement, then anyone who has satisfied that service requirement at that point of time that the plan document is amended would still be entitled to the contributions. And once again, Chuck, the non-discrimination testing should be considered. I know this is one of your #1 questions. You and I have chatted about this. I'm sure you've been dealing with some of this.
Yes, yeah, we certainly have. And it is a question that comes up quite a bit, and it's come up before, but recently a lot of companies are in this spot saying, we need to be saving payroll or in expenses, just overall employment expenses, and we can't really change the healthcare benefits. Is this something we can do? And then the other question is, if I turn it on, turn it off, can I turn it back on? And when can I do that? So as John said, the key thing is looking at your plan document, reviewing it, and discussing it with your advisor and your record keeper. Great.
Right on the money, Chuck.
Great. The second question, John, can a safe harbor 401k plan be amended to suspend or eliminate the safe harbor contribution?
Great question, Chuck. Again, one of the top ones that we're seeing across the RLC consulting lines. A safe harbor plan Obviously many folks have instituted the safe harbor concept to eliminate discrimination and make it easier for the HCEs to maximize what's going on in the plan. And also it's a great benefit. But can the safe harbor be amended or suspended? Under limited circumstances, the answer is yes. And we're going to get into those limited circumstances probably being quite expanded. So I'm going to say in 99.9% of the cases, and Chuck, you and I have talked about this, I'll let you chime in, on an economic loss basis. You can indeed amend even if you're a safe harbor. We actually published a case of the week on this that Chuck and the Finspire team have, if you'd like to read a copy of it, that was published in NAPANet. But under limited circumstances, according to final Treasury regs, a sponsor of a safe harbor can amend the plan during the current year to reduce or suspend the company's safe harbor contribution. And they can do that with either the matching or the non-elective contribution. However, then the plan is now going to be subject to actual deferral percentage, ADP, and our actual contribution percentage, ACP, testing. And that was probably the original reason why you put a safe harbor plan in. So now you're going to be subject to the discrimination testing. But it can be done. And if you're looking to shore up the plan in the short term here, it absolutely can be done. So a removal or reduction of the safe harbor mid-year is permitted if the employer is one of two categories. The first category, Chuck, and this is going to be a broad net. Is the company operating under a, quote, economic loss for the year? And we have some IRC code there. There is not really a definitive definition. But I'm sure almost all businesses, probably that are on the phone here, hopefully not all, but many, are experiencing some type of a more difficult situation than they were last year. If that can be defined, and there is no litmus test in writing about what an economic loss is, so this is a very broad net that can be utilized if you need to amend or suspend the safe harbor contribution or structure. So the economic loss category is probably putting us into the category of 99.9% of plans can do if they need to. The second category is if there is included in a statement the safe harbor notice given to participants before the start of the plan year. So cat's probably out of the bag here, but before the start of the plan year, that can be done. We might be thinking of considering this for next year. But you may reduce, suspend these contributions mid-year. And you'll have to give participants a supplemental notice regarding the reduction and suspension. But it needs to be done also with at least a 30-day after the receipt of the supplemental notice is when this can kick in. So the short answer, Chuck, is yes, you can. It's a little more complicated than a standard plan, but absolutely can be with some good guidance and consulting from the folks at Finspire. I don't know if you want to chime in on this, Chuck. I know you got a lot of safe harbor folks out there.
We do, yeah, and this is something that, and that's right, exactly what we've been telling is what John mentioned there. One thing that comes up is that there's different types of safe harbors, and most of them are match safe harbor, but some are not. They're non-elective ones where it is a 3% basically profit sharing type of contribution. Can you talk a little bit to that, John? Any difference there if it's a qualified non-elective contribution versus a match?
Well, that's a great one. Heidi Lemire is on our line. She's one of our senior consultants. She deals with these cases all along the time. Heidi, do you want to chime in on Chuck's question?
Absolutely. So as John mentioned, in order to have that suspension apply, the employer needs to either be operating at an economic loss, again, more guidance to come on that, or the maybe notice is going to be provided. That's the supplemental notice that's included in the safe harbor notice. One thing to note there is most plan providers already include that additional language that the contribution may, in fact, be eliminated or reduced. So certainly check with Chuck to determine if that's something that your plan currently has included. When we're looking at the reduction of the non-elective or the matching contribution, one thing that you need to keep in mind is any employee who has already earned that contribution for the year would need to still receive that contribution up until the point that that has been reduced or eliminated. And then going forward on a prospective basis, we could have that amount reduced. Keeping in mind that depending on the plan document, you may need to provide additional documentation and notices to employees that the additional or normal contribution has been resumed in the future.
Great.
Yeah, right on the money, Chuck. I know you've been guiding and talking to folks. That maybe notice is really key. If when if you're in this safe harbor situation, I think the first thing you need to do, that's an automatic. Let's get the document to Chuck and James and Chris. Let's review. Let's check if that maybe notice is in. If it's not been in, let's make sure it is for next year.
Great. Yep. Great point. Thanks, John and Heidi. The next one, and this is coming up a lot, particularly as companies are looking at potential layoffs. A unique thing of this versus 2007, 2008 is companies are looking more at furloughs than before versus just layoffs. It's partial kind of temporary work stoppages for employees. And with that comes up partial plan terminations. So can you talk about when a partial plan termination happens, John, and what are the ramifications of that?
Right on, Chuck. Partial plan terminations are one of those things that happen during every economic cycle or individual business-specific situation that plan sponsors, they kind of sneak up on you. You're not necessarily aware or thinking. You're thinking of your business like everybody is now. You're thinking of preserving the business. Some of the work that I know you're doing, Chuck, at Finspire on helping with the PPP loans and all that kind of stuff. But then sometimes you're not thinking about your plan. But here's the situation, because there is a material impact if you're deemed by the IRS to be in a partial plan termination, which of course is tied into reducing workforce. So we did publish another case of the week on this. For those of you who want to get a copy of it, Chuck and James can send it to you as well for reading. But the short answer is when a significant number or percentage of employees who are participating in a business's qualified plan, they're terminated, and I'm using the term terminated here, and they're no longer eligible to participate, and I'm saying no longer eligible, meaning not expected to be coming back. So they're terminated, they're no longer eligible to participate in the plan. Then a partial plan termination, and that's a technical ERISA term there, may have occurred in the eyes of the IRS. The determination is based on the facts and the circumstances of each case by case, but we've got some good guidelines. The IRS requires that all participants covered under the portion of the plan that's deemed terminated become 100% vested in matching or other contributions if the contributions were subject to a vesting schedule. But essentially what we're looking at is if we see a termination, if you will, by at least 20% of the workforce, okay, so this is a broader definition than this plan, reduces its workforce in total by 20%, then it's deemed that we're in a partial plan termination situation. This is often called technically in Department of Labor terms a reduction in force of the workforce by at least 20%. Now the presumption is rebuttable. For example, an organization that's in an industry where turnover rates are routine for that employer, you can think of restaurants, or more transient employer type organizations, then they can rebut that back to the IRS. But a partial plan termination may really be an issue here. You mentioned, Chuck, already in your comments the concept of furlough. Furloughing employees and not officially terminating them, meaning we're in an uncertain time, certainly. We're managing cash flow, absolutely. We're therefore making these decisions, but we expect things to bounce back at some relatively short or intermediate term. And if so, we may bring these people back. Now, that would put you in a different category and might be a nice, elegant solution for getting around this partial plan termination. So, Chuck, I know you've worked on this, and you and I chatted about this. You're probably seeing some of these cases coming across your desk.
We are, yes. We in that discussion, and this is sort of early. Most companies haven't made big decisions on this, but some have. But more than this is definitely in the thought process.
Yeah, and this bleeds into, Chuck, some of the stuff you're doing on the PPP loan stuff. If you're going to be applying for the PPP loan, right, then you're going to be protected from payroll. And part of that is they put a 25% cap, I believe, on payroll. If you're reducing payroll by 25%, that might subject you to not being able to have the forgiveness on the loan. So I think this is where the consulting work that you do at Finspire really shines, because it's a combination of business consulting that has ramifications on your plan. You're not usually leading with thinking about your plan first, but the two go hand in hand in here. But the elegant solution in the short term, in my opinion, Chuck, I don't know what you think, is what you said in the beginning. Furlough first before official termination, which gives you some leeway on this partial plan termination.
Yep, I agree. Yep, thanks, John. For the next one, can we change the plan's funding frequency from per payroll to year end? And that's come up a couple times also, is we're going to continue making the contribution, but can we delay this?
The short answer, yeah, Chuck, the short answer is we absolutely can. And I'm going to ask my colleague Heidi to chime in on this one. It really depends on, again, whether we're a safe harbor situation or not. But the answer is yes, and I'll let Heidi field this one.
Thank you, John. Yeah, and you're absolutely correct. So short answer, yes, you can change the funding frequency. So for example, if you're typically making an employer contribution via a per payroll basis and you're looking to possibly change that to once at the end of the year, it definitely is possible, but there are some things to consider regarding the type of plan you currently offer. So if you're offering your employees a standard 401k plan, so a non-safe harbor plan, first you'll want to take a look at your plan document to determine whether or not there is a need to officially complete an amendment. There are a lot of plan documents out there that do have language built into the plan that relates to the frequency of the employer contributions. And if it is addressed that it be made on a per payroll basis, then there does need to be an official amendment made to add that additional flexibility, providing the employer the ability to change. Now, if the plan does not have that specific funding timing language built in, then a plan amendment would not be required. So there would be automatic flexibility there. So really important to make sure that you're checking your document and see what the underlying language is as far as how the frequency is built in and whether or not you can change that with or without an amendment. Now for the safe harbor 401k plans, again, there's an option to change from per payroll funding to a year-end funding with a retroactive plan amendment. So again, we would be amending the plan because those are typically set up to provide a set specific contribution to employees. We would need to retroactively amend the plan and then provide notice to employees no later than 3 months before the end of the plan year that the frequency or timing of the employer contribution has been changed.
Great. Thank you very much, John. Heidi, that was very helpful. And one thing I'll just put a note of clarification is when we're talking about the plan's funding, really that's the employer contribution. So one thing I stress to my clients and other employers is this doesn't change what you need to do when the employee puts their money into it. That has to go in, again, in a reasonable amount of time, generally 2 to 3 days from when you take it out. So nothing, you don't have any kind of flexibility on that. It's just the employer contribution we're talking about there. And so these first 4 questions that John and Heidi went through, I want to note that none of these laws changed as a result of the CARES Act. So this is nothing new on this. It's just how do we implement these? So there hasn't really been any change from any legislation that affects any of these first 4 questions, really, in terms of a legislative change. The last we'll talk about is hardship distributions. So our hardship distributions, as a result of COVID-19, exempt from the 10% early with distribution penalty tax. And this, as John will talk about, that this does have relevant to the new CARES Act. So John, do you want to talk about that?
Right on, Chuck. And, it's interesting. I'll take a pause here because I think you and James planned this very intelligently when, in the beginning of the call, when I saw what was the number, 15% of folks weren't thinking about making changes prior to this year. So the majority who were in our Goldilocks economy and market, why would you make a change? Things are going great. As you point out quite well, Chuck, this is the stuff that you guys do day in and day out. It's just a lot more people are subject to questions 1 through 4 now, so that if we probably repoll, if James repolls how many are going to make a change, numbers might flip here, but those are existing ERISA things that, Chuck, you do, I know, day in and day out. It's just bringing them all to bear here in this challenging environment. But as you said, the new stuff, question 5, and you nailed this pretty well in the earlier part, Chuck, so I'll just breeze through this. But hardship distributions for participants as a result of COVID-19, are they exempt from the 10% early distribution penalty? And the short answer is a couple of weeks ago, the answer would be no, maybe. Now the answer is firmly yes. Yes, under the newly enacted Coronavirus Aid, Relief, and Economic Security, and there you actually have the words behind the CARES Act. The IRS will indeed waive the 10% early distribution penalty for the first $100,000 of a coronavirus-related distribution for an eligible retirement plan participant due to coronavirus, and I'll define that a little bit, and you did as well too. The interesting thing about this, which makes this quite attractive, in particular vis-a-vis if someone's considering, do I loan, do I distribute, this distribution, again, number one, not subject to early distribution penalty. Number two, you can pay back the loan amount within 3 years, and you can pro-rata it over those 3 years. So if a participant takes $90,000, for example, they can deem it as they took 30 this year, 30 next year, 30 the following year, so it can be prorated. And the taxation, which it would be subject to taxable if it was traditional 401k money, also spread out over 3 years. So no 10% penalty income tax, but the income tax spread out over 3 years. And also, Chuck, as I think you pointed out as well too, this term eligible retirement plan is not just limited to 401k. It also includes IRAs. So that's our small business SEPs, that's regular IRAs, any qualified plan, 401k, 403b, and even our government 457 plans. So that's very interesting. The final point, and you nailed this earlier too, Chuck, is there is not going to be any federal withholding amount. Normally, if you're taking a distribution, you could be subject to the 10% penalty. If it's, non-hardship, that's no longer there. Now you've got the 3-year window for taxation and payback. And in addition, in my example, if someone took the $90,000, they'd get the full $90,000. There's not a 20% federal withholding amount. So it's very attractive. You talked about too, Chuck, the folks that are eligible for this is a very broad net. It's a self-attest, so nobody's asking for a doctor's notice. But it's an individual or his or her spouse or dependent who's diagnosed with the virus, or someone who's impacted by quarantine, furlough, laid off, subject to reduced work hours, which means probably lower compensation, unable to work due to lack of child care, et cetera. So it's a very broad net that they're casting here for folks who hopefully as a last resort, and Chuck, I think you're going to get into other areas where participants can look before they come to their retirement plan. But if they need to come to their retirement plan, this is a very constructively laid out piece of legislation that's implementable right now.
Great. Thank you very much, John and Heidi. It's great insight into these 5 common questions. We'll just ask James to put up the poll very quickly on these questions that you have. So which are the below questions you have regarding your company plan? So any of these apply to you. And this is, again, we're getting a lot of questions on this. One thing I'll also note is with that loan feature I talked about, we're adding a loan. One thing I'm running across is companies say we want to put this loan provision in to it, but they currently only allow 1 loan. So that is something you actually would need to amend the plan and have multiple loans. If you're going to have, somebody already had an existing loan, they want to take advantage of this to amend it to allow another loan for the new COVID-19 loan feature. So again, it all kind of goes back to John and how you mentioned is it really want to review your plan document, go through this. And then a real important thing is how you're communicating this to the employees and you're getting that information out to them. And we've seen companies taking different routes on that. So if I look at the polling here, we've got about 50% of the respondents said, when does a partial plan termination happen? That was a key one. 30% are asking about hardship distributions. So those are some of the main responses to the question. So thank you all for responding to that. So I am going to show you the results very quickly. I'll just go on to the next slide in the interest of time because we're running a little late. So these are really what John and Heidi talked about. Questions that are coming up. One, terminating a plan. Some companies have said, can I just terminate the plan? And that's really kind of the nuclear option. And most companies generally are not doing that. Are they able to? Yes, because everyone becomes fully vested. You're forcing employees to take money out, not able to save. Big issue if somebody has loans and you terminate the plan, those are deemed distributions. They pay taxes and penalties on it. And generally, if you terminate a plan, you can't start another one for 12 months. It's called the successor plan rule. So we don't normally see that as much. But just so you're aware of that, plan amendments, mid-year safe harbor amendments, and then this partial plan termination. So just a quick summary of the 4 things that John and Heidi covered. Again, feel free to reach out to us if you have questions. Another thing is at the employee level. And a really good question came in the Q&A from one of the participants here today. They asked, curious your thoughts on CARES loan provision, although eased for the time, seems a bit dangerous for everyday Americans. And I couldn't agree more with whoever submitted that question is, yes, you can, but should you? So when we're talking to individuals and they're looking at maybe stopping their contributions, changing their investment allocation, taking a loan or taking a withdrawal. Now, the taking a loan or withdrawal is, do you need the funds right now? Are you really in a spot, and not everybody is impacted the same way. I always worry about you add these provisions in and people need them because we know historically that while their intent is good and they're going to put it back in, most don't. And I often talk to employees, here is the long-term impact of it. 50-year-old taking $20,000 out. And again, sometimes they need it, sympathize for that, and we want to make sure it's available. They're available for it, but just being cautious about that. And I am concerned about that, the leakage from these plans and what impact that'll have long-term. So that's why it's really important that you have a communication strategy with the employees to talk to them about it. So they understand it. I'm not sure it's what you want to necessarily promote as a great thing in a plan, but just let them know that this is available, or if I should say, may not want to be encouraging them necessarily to take the loans out. So these are things that we're talking to employees about. So finish kind of best practices, and this again, this continues. Reviewing your plan design, understanding your options in the plan document. Looking for creative plan design solutions to address current issues while positioning company for future success. So it might be you just change something in it. So one other thing talked about, can we delay our employer contribution to the end of the year? That's really what we're looking to do. That might be something without changing the plan design, or you switch it to a more of a profit sharing kind of a contribution. So lots of things really want to talk over with this. The same thing I tell individual employees, I tell plan sponsors, is kind of careful about making a knee jerk and really look at short-term, just long-term impact. The investment management process, great time to reviewing the options inside of your plan. I will tell you as a firm, Finspire, we are very hesitant to switch a fund in the middle of this type of situation. Just because it is so unusual, and this kind of thing where you look at performance, and this last 3 months, I would in some respects say it's irrelevant a little bit how well a fund did in this last 3 months, because nobody could have prepared for this kind of environment. Employee education is more important now than ever. They're really looking to you as the plan sponsor to help them with that. And then overall plan governance, don't stop doing that. All the things that you're doing on your plan, sometimes these things get pushed to the side by companies when they're going to this type of a situation. So make sure you're continuing to do that. Here is our team. Just reach out to us, myself, Jason Brooks, certified financial planner, CPA on our group, Chris Karam, Chief Investment Officer. And then we have a separate plan participant services phone number as well as email. This is for your participants. If they have questions, you can call, leave a message in our voicemail box, and we'll return it, or send us an email. We also have James Jaramillo, who's on the line, who's relationship manager. Many of you are, all of our clients certainly know James, and works with us on the day-to-day. So we'll have a final poll question, and I'll see if there's any other questions, James. Would you like us to contact you to set up an individual discussion? Simple yes or no. If you do that, then we'll get that information, follow up with you with email or call, set up an individual discussion to review your plan, any questions that you have. Again, we're happy to do this and make sure you're getting all the answers that you need. Also, as a reminder, this is going to be the first of a series. seminars. So if there's something we didn't talk about today that you were really curious about, send us an email on that as well. We'll answer it to you. We'll also might see this in future webinars that we're having. With that, again, I'll thank you all for your time today. I wish everybody the best health and safety during these challenging times. Don't hesitate to reach out to us. Thank you very much to John, Carl, and Heidi from the Retirement Learning Center. Also want to give acknowledgement to Bill Beardsley at Columbia Threadneedle, which is a terrific investment firm that we work with and was instrumental in putting all of this together. It's just been a great resource for us and for our clients.